Hello, people, welcome back to our sessions. Let's discuss the remaining questions of section 1, chapter 1, accounting periods and accounting methods. Let's see the first one. In order to adopt a fiscal tax year on its first federal income tax return, the taxpayer must A. Attach a completed Form 1128 to its fiscal year basis income tax return. B. Maintain books and records and report income and expenses using that tax year. C. File a short period return. D. Get IRS approval. Let's see what is the answer. The answer is B. Let's see why the other two options are wrong. Option A, this option is incorrect. Form 1128 is used to request approval for a change in tax year. It is not typically required when a taxpayer is adopting a fiscal tax year for the first time on its initial federal income tax return. So, option A is incorrect. Option C, this option is also incorrect. Filing a short period return is not necessary when adopting a fiscal tax year for the first time on the initial federal income tax return. So, option C is wrong. Option D, this option is also incorrect. Generally, a taxpayer does not need to obtain IRS approval to adopt a fiscal tax year on its first federal income tax return. The process for adopting a fiscal tax year is different from requesting a change in tax year, which may require IRS approval. So, option D is also wrong. Option B is the correct answer. So, here, when a taxpayer adopts a fiscal tax year on its first federal income tax return, it is required to maintain books and records and report income and expenses using that fiscal tax year. The taxpayer should consistently apply the chosen fiscal tax year for its financial reporting and tax reporting. Option B is the correct answer. Let's go to the next question. Which of the following is not a recognized accounting method for tax purposes? Let's see the options. Option A is accrual method, option B is hybrid method, option C gross receipts method, option D cash method. Let's see the answer. The answer is C. Let's see why the other three options are wrong. Option A, the accrual method is indeed a recognized accounting method for tax purposes. It recognizes income when earned and expenses when incurred, regardless of when cash is received or paid. So, option A is a recognized accounting method. Option B, a hybrid method, is a recognized accounting method for tax purposes. It involves a combination of both the accrual and cash method for reporting income and expenses. So, option B is also recognized accounting method. Option D, cash method, it is also one of the recognized accounting method for tax purposes. It recognizes income when received and expenses when paid. So the correct answer is C, gross receipts method. It is not a recognized accounting method for tax purposes. It is not a standard method for determining taxable income and is not commonly used for reporting income and expense. Let's go to the next question. Generally, a substantial business inventory requires use of which method of accounting? A. None of these choices. B. Cash. C. Accrual. D. Hybrid. Let's see the answer. The answer is C. Accrual. Let's see why it is C. So, generally, a substantial business inventory requires the use of accrual method of accounting. The accrual method matches income and expenses when they are earned or incurred, regardless of when cash is received or paid. So, this method is more suitable for businesses with substantial inventory to accurately track their financial transaction. So, option C is the correct answer. Let's go to the next question. Which of the following statements is not true regarding bookkeeping system? Option A, double entry system is based on the income statement and balance sheet. Option B, a single entry system is based on the income statement. Option C, a double entry system is self-balancing. Option D, a single entry system uses journal and ledger. Let's see what is the answer. The answer is D. Let's see why it is D. So here a single entry system uses cash receipts and reimbursements and is only built around the income statement. The double entry system uses journals and ledger. So it is based on the income statement and balance sheet and is self-balancing. So option D is the wrong answer because double entry system is uses journal and ledger, not single entry system. So option D is the wrong answer. Let's go to the next question. Once a taxpayer set up an accounting method and files a first return, the taxpayer must generally get IRS approval to change the method. Which of the following does not require IRS approval? Option A change from the cash method to an accrual method or vice versa. Option B, an adjustment in the useful life of a depreciable asset. Option C, a change in the method of figuring depreciation except certain permitted changes to the straight line method for property placed in service before 1981. Option D, a change in the method or basis used to value inventory. Let's see the answer. The answer is B. Let's see why the other three options are wrong. So here option A, changing from cash method to accrual method or vice versa, generally requires IRS approval. It is a significant change in accounting method that typically necessitate proper documentation and IRS consent. So option A is wrong. Option C, here also, generally change in the method of figuring depreciation requires IRS approval. So certain changes may be permitted without approval. The option presented here is not one of those exceptions. So option C is wrong. Option D, a change in the method or basis used to value inventory generally requires IRS approval. Inventory valuation is a critical component of a business financial reporting, and changes in valuation methods can have significant tax implications. So IRS approval is needed. So the correct answer is B. Here, change in the useful life of depreciable asset may impact the calculation of depreciation. They typically do not require IRS approval. Taxpayer can generally make adjustment to the useful life of depreciable asset without seeking specific approval from the IRS. So option B is the correct answer. Let's go to the next question. Which of the following accounting changes that does not require the filing of Form 3115 to request a change in accounting method? Option A, correction of a math error. Option B, change from accrual method to cash method. Option C, change from cash method to accrual method. D, change in method inventory's value. Let's see the answer. The answer is A. Let's see why the other three options are wrong. So here, change from accrual method to cash method or cash method to accrual method, IRS approval is needed. And here, the accrual method recognizes income when earned and expenses when incurred, regardless of when cash is received or paid. The cash method, on the other hand, recognizes income when cash is received and expenses when cash is paid. So such change would likely require the filing of Form 3115 because it involves a significant shift in accounting principles. So option B, C, IRS approval is needed. Option D, here valuing inventory is a critical component of financial statement and it affects the calculation of cost of goods sold and income. So changing the method by which inventory is valued can have a significant impact on company's financials. So such change would typically require the filing of Form 3115. So B, C, D requires approval from the IRS. Option A doesn't require the approval because it doesn't involve changing the overall accounting method. It is just a simple calculation to rectify an error. So it does not require the filing of Form 3115. Let's go to the next question. Which of the following entities cannot use the cash method of accounting? A, both a qualified principal service corporation and a tax shelter. Option B, neither a qualified personal service corporation nor a tax shelter. C, a tax shelter. D, a qualified personal service corporation. Let's see the answer. The answer is C. Let's see why it is C. So here, the entities who cannot use the cash method are corporation and partnership, who is having annual gross receipts exceeding 27 million for the past 3 years, and tax shelter. So here, corporation, partnership, and tax shelter are not supposed to use the cash method. So the answer is C. Let's go to the next question. Which of the following accounting method is not an acceptable method of reporting income and expenses? Option A, if an inventory is necessary to account for income, taxpayer must use an accrual method for purchases and sales. Taxpayer can use the cash method for other items of income and expenses. Option B, any combination that includes the cash method is treated as the cash method. Option C, taxpayer can use different accounting methods for reporting business and personal items. Option D, if taxpayer use the cash method for figuring income, taxpayer can use the accrual method for figuring his expenses. Let's see the answer. The answer is D. Let's see why it is D. So this option is not acceptable method of reporting income and expenses. The IRS generally requires consistency in the use of accounting method for both income and expenses. If a taxpayer uses the cash method for reporting income, they are generally expected to use the same method for reporting expenses. So mixing different accounting methods for income and expenses is not allowed under standard regulation. So if a taxpayer chooses to use the cash method for reporting income, they are typically required to use the cash method for reporting expenses as well. So the IRS aims to ensure that financial reporting remains consistent and accurate, which is why mixing different methods for income and expenses is not permissible. So option D is the right answer. Let's go to the next question. Taxpayer earned 1000 in interest in 2020 and is credited to his account. Taxpayer withdraws 700 in 2020 and 300 in 2022. How much of the original 1000 should the taxpayer report as interest earned in 2022? A 1000, B 700, C 0, D 300. Let's see the answer. The answer is C. Let's see why it is C. So here the taxpayer should not report any interest earned in 2022. This is because the taxpayer would have reported 1000 as interest earned in 2020. It does not matter when he withdraw the income. So normally under the cash method of accounting including gross income, all the items of income actually or constructively received during the year. So if a taxpayer receives property and services, he must include that FMV in income. So here, as he received the amount in 2020, he need to report it in 2020 as income. Let's go to the next question. Which of the following statement is not correct? A. An under accrual method of accounting, business expenses and interest owed to a related party who uses the cash method of accounting are deductible when all the event test has been met. Option B. Under an accrual method of accounting, taxpayer can deduct a current deduction for taxes when economic performance occurs. Option C. Under an accrual method of accounting, taxpayer generally reports income in the year earned and deducts or capitalizes expenses in the year incurred. Option D. Under an accrual method of accounting, taxpayer generally reports receipt of an advance payment for service to be performed in a later tax year as income in the year he receives the payment. Let's see the answer. The answer is A. Let's see why it is A. So here this statement is incorrect because under the accrual method, expenses are generally deductible when they are incurred and economic performance has taken place. So interest owed to a related person under the cash method is generally deductible when actually paid, not when all events test is met. So option A, here until the taxpayer makes the payment and he includes in the gross income, it cannot be included under the accrual method. So option A is the wrong answer. Sorry, option A is the right answer. Let's go to the next question. Kiran Partnership sells computers and maintains its accounting system on the accrual basis. Kiran sold and delivered a computer on December 29, 2021 and billed the customer to 3,250 on January  7th, 2022. Kiran received the 3,250 payment on February 15, 2022. The check cleared on February 22nd, 2022. On which date will Kiran recognize this income? Let's see the options. Option A, February 22nd, 2022. Option B, February 15, 2022. Option C, December 29, 2021. Option D, January 7th, 2022. Let's see the answer. The answer is C, December 29, 2021. Let's see why it is C. So option A, this option is incorrect because February 22nd, 2022 is the date the check cleared, which is the date of payment, not the date when the income was earned. So option A is incorrect. Option B, it is also incorrect because it is the date when the payment was received, not the date when the income was earned. So option B is also incorrect. Option C, option D, this is also incorrect because it is the date when the bill was sent to the customer, but the income should be recognized when the sale and delivery took place. So it took place on December 29, 2021. So it is the answer. So the income should be recognized on the date when the computer was sold and delivered. In an accrual accounting system, revenue is recognized when it is earned, not when cash is received or when payment is clear. So option C, December 29, 2021 is the answer. Let's go to the next question. Mohan is an accrual basis taxpayer. He shipped 500 worth of merchandise to Raju on December 30, 2022. Mohan sent Raju an invoice January 2nd, 2023 that was payable in 30 days. Raju mailed his check to Mohan on February 2nd, 2023. Mohan deposited the check on February 6, 2023. Mohan received and reconciled his bank statement March 3rd, 2023. When does Mohan record the 500 in income? So let's see the options. Option A, January 2nd, 2023 because that is when he invoiced Raju. Option B, December 30, 2022, the date when he shipped the merchandise to Raju. Option C, March 3rd, 2023. March 3rd, 2023 because that is when Mohan verified that the 500 check had been accepted as a deposit. Option D, February 6, 2023 because that is when Mohan deposited the check from Raju. Let's see the answer. The answer is B. Let's see why the other three options are wrong. So option A, in accrual accounting, revenue is recognized when it is earned, which generally occurs when goods are shipped or services are provided, not when an invoice is sent. So option A is wrong. Option C, here the verification of a check's deposit does not determine the recognition of income. Income should be recognized when the revenue is earned, which is typically when goods are shipped or services are provided. So option C is wrong. Option D, this option is also incorrect. The act of depositing the check does not determine the timing of recognizing income. So income should be recognized when the revenue is earned, which is when the goods are shipped or services are provided. So option D is wrong. The correct answer is B. So December 30, 2022, in accrual accounting, revenue is recognized when it is earned, which is generally when goods are shipped or services are provided, even if the payment has not yet been received. So in this case, the income is recognized on the date when the merchandise was shipped to Raju, which is December 30, 2022. Let's go to the next question. Mary is a calendar year accrual basis taxpayer. She sold merchandise on December 2022. She billed the customer in the first week of January 2023. The billing was returned for insufficient postage and Mary sent a second bill in February 2023. When should Mary include the sale in income? Option A, January 2023. Option B, February 2023. Option C, March 2023. Option D, December 2022. Let's see the answer. The answer is D. Let's see why it is D. Here, since Mary is an accrual basis taxpayer, income should be recognized when it is earned, which is when the sale of merchandise took place. So the fact that Mary billed the customer in January and February does not change the timing of income recognition. The sale was made in December 2022, so that it when Mary should include the sale in income. So option D is the correct answer. Let's go to the next question. With regard to the accrual method of accounting, which of the following statement is false? A. Under the accrual method of accounting, a taxpayer can elect to treat taxes as a recurring item or can elect to ratably accrue real estate taxes. Option B. Under an accrual method of accounting, a taxpayer generally deducts the expense when the all event test has been met and economic performance has occurred. Option C. An employer can take current deduction for vacation pay earned by employees if the employer paid the vested amount within 2.5 months after the end of the year. Option D. An accrual basis corporation can deduct expenses owed to a related cash basis taxpayer when payment is made, regardless of when includable in the gross income of the person paid. Let's see the answer. The answer is D. So let's see why the other three options are wrong. So option A, this option is incorrect. Under the accrual method, taxpayer have the flexibility to choose how they treat taxes. So they can either treat them as a recurring item or elect to accrue real estate tax ratably over the year to which they relate. So option A is correct. Option B, the statement is also correct. Under the accrual method, expenses are generally deductible when both the all events test has been met and the liability is fixed and determinable and economic performance has occurred. So option B is also correct. As we have to find out the incorrect statement, option B is wrong. Option C, this is also correct. Under the accrual method, employer can deduct vacation pay accrued but unpaid at the end of the year if it is paid within 2.5 months after the end of the tax year. So this is a common exception to the general rule of economic performance. So option C is also incorrect. Option D is the correct answer, because here the matching principle in accrual accounting requires that expenses be matched with the revenue. They help matches with the revenue that they help to generate. So expenses owed to relate cash basis taxpayer should generally be deductible when includable in the gross income of the person paid, not simply when the payment is made. So option D is the wrong answer. Sorry, right answer. Let's go to the next question. If a company is an accrual taxpayer, what is the amount of gross receipt reported on the taxpayers form 1040 schedule C based on the information below? Service income 25,000, gain on sale of an asset 1500, interest on accounts receivable 3000. Let's see the options. Option A 25,000, option B 26,500, option C 29,500, option D 28,000. Let's see the answer. The answer is A 25,000. Let's see why it is A. So here service income, it is a business income, it must be reported in schedule C 25,000, and gain on sale of an asset, it is a capital gain, so it must be reported on schedule D, so it is not includable in schedule C. And interest on accounts receivable is 3,000, so it must be reported in 1099 INT. So only income which must be reported on schedule C is A 25,000. Let's go to the next question. All of the following would be included in the gross receipts of a business for a tax year except A. Sales made but income not collected during the tax year for a business using an accrual method. Option B. Sales tax is collected by a business using the cash accounting method. C. Lease bonus and lease cancellation payments received from a lessee renting personal property or real estate from the taxpayer. Option D. FMV of property the business received in exchange for a good or service barter. Let's see the answer. The answer is B. Let's see why the other three options are wrong. So option A, this option is option is correct. This statement is correct. Under the accrual accounting method, income is recognized when earned regardless of when cash is received. So sales made but not yet collected would still be includable in the gross receipts. As we have to find out which is not included in gross receipts, option is incorrect. Option C, this statement is also correct. Lease bonus and lease cancellation payments received are considered part of the business gross receipts. So option C is also incorrect. Option D, barter transaction. It involves the exchange of goods or service, and the FMV of property received in exchange would be still includable in the gross receipts. So option D is also incorrect. Option B is the correct answer because sales tax collected by a business using the cash accounting method are not considered part of the business gross receipts. Sales tax collected are typically liabilities that the business collects on behalf of the government and remits to the appropriate tax authority. They do not represent the business income and should not be included in the gross receipts. Let's go to the next question. Generally, all of the following entities may use the cash method of accounting except A. A farming corporation with gross receipts of 27 million or less, an entity with no inventory and average annual gross receipts of 27 million or less, a qualified personal service corporation, option D, a corporation other than S corporation with an average annual receipts exceeding 27 million. Let's see the answer. The answer is D. Let's see why it is D. So here option D is incorrect because corporation with average annual gross receipts exceeding 27 million are generally not allowed to use the cash method of accounting because it is crossing the threshold limit. So they are required to use the accrual method. The other three options are below the threshold limit of 27 million. So they can use the cash method of accounting to report their income and expenses. So option D cannot use the cash method. Let's go to the next question. Given the fact pattern below, which of the following entities may not use the cash method of accounting? A partnership had gross receipts of 3.5 million in 2022. Its gross receipts of 2021 were 8 million and its gross receipts for 2020 were 3 million. Option B, a sole proprietor manufactures and sells fans. His average annual receipts since 2018 are 975,000. So option C, a partnership has two partners in 2021, an individual and a corporation. The partnership average annual gross receipts are 2.75 million. And option D, a sole proprietor files his 2022 Form 1040 with an attached Schedule C reflecting 1 billion in gross receipts from selling real estate. Let's see the answer. The answer is C. Let's see why it is C. So option A, here this option is incorrect because if we calculate gross receipts for the past 3 years, it is not crossing 27 million. So the partnership in this scenario falls under the threshold and could use the cash method. And option B also falls below the threshold limit of 27.5 million. So sole proprietor can use the cash method. And option D, option D is wrong because it is 1100,000. It is not 1 billion. So option C is the right answer since it is crossing 27.5 million. 27 million. So option C is the right answer. Option D, it is not 1 billion. It is 1100,000 or 1.1 million. It is not 11 billion. So it is 11 million. So as it is below the threshold limit of 27 million, so option C is the right answer. So since they are crossing 27 million, they cannot use the cash method of accounting. Let's go to the next question. Which of the following individual is not considered a related party for deducting expenses on the accrual method? A. Half sister. B. Brother. C. Mother. D. Stepsister. Let's see the answer. The answer is D. Stepsister. Let's see why it is D. A stepsister is not generally considered a related party for tax purposes unless there is some other level of control or financial arrangement involved. So, in many cases, the relationship between step siblings is not treated the same as direct sibling, so they are not treated as related party. So, only brothers, sisters, husband and wife, ancestor, and linear descendants are considered as related party. Let's go to the next question. Which of the following statement is not correct? Option A. Under an accrual method of accounting, you generally report income in the year earned and deduct or capitalize expenses in the year incurred. Option B. Under an accrual method of accounting, you generally report receipts of an advance payment for service to be performed in a later tax year as income in the year you receive the payment. Option C. Under an accrual method of accounting, business expenses and interest owed to a related person who uses the cash method of accounting are deductible when the all even test has been met. D. Under an accrual method of accounting, you can take a current deduction for taxes when economic performance occur. Let's see the answer. The answer is C. Let's see why it is C. So here the statement is incorrect because it is stating that under an accrual method of accounting, business expenses and interest owed to a related person who uses the cash method of accounting are deductible when the all events has been met. So expenses owed to a related cash basis taxpayer are generally deductible when all events has been taken place and when economic performance occurs. So if these two are the case situation, then they can include. So option C is the option C is the right answer. Let's go to the next question. Which of the following is not an acceptable inventory practice? A. You can claim a casualty or theft loss of inventory through the increase in the cost of goods sold by properly reporting your opening and closing inventories. Option B. To properly value inventory at cost, reduce the invoice price of inventory by a trade discount. Option C. Under the lower of cost or market method, compare the market value of each item on the hand on the inventory date with its cost and use the lower of the two as its inventory value. Option D. To properly value inventory at cost, include only the direct cost associated with each item. Let's see the answer. The answer is D. So let's see why it is D. So here properly valuing inventory at cost involves not only including direct costs but also indirect costs that are necessary to bring the inventory to its present condition and location. So this may include costs such as flight, handling and storage. So it does not include only direct costs, it will be including indirect costs as well. So option D is the correct answer. Let's go to the next question. A partnership, S corporation or personal service corporation can elect to use a tax year other than its required tax year if it is A. Elects a year that meets the deferral period requirement. B. Is not a member of tiered structure as defined by the regulations. C. Has not previously had an election in effect to use a taxpayer year other than its required tax year. D. All of the above. Let's see the answer. The answer is all of the above. So let's see why it is all of the above. So A, B, C. This option refers to the requirement that the requested tax year must result in a deferral of income to partner, shareholder, or owner. So the entity can elect a tax year other than its required tax year if it meets this deferral period requirement. And the second one, it relates to the limitation on certain entities in tiered structure from electing a tax year other than the required tax year. So tiered structure involve multiple level of entities and there are restriction on certain type of entities within such structures. So option B is also one of the requirement. Option C, It indicates that an entity can make the election to use a tax year other than its required tax year if it has not made such an election in the past. So all these conditions must be satisfied in order for a partnership, S corporation, or personal service corporation to elect to use a tax year other than its required tax year. So A, B, C, they are the conditions. Let's go to the next question. Which of the following accounting changes do not require the consent of the IRS? A. Correction of matter. B. Change from accrual method to cash method. C. Change in method inventory is valued. Change from cash method to accrual method. Let's see the answer. The answer is A. So B, C, D requires IRS approval to change from accrual method to cash method to accrual method, and inventory methods, change in the inventory methods. So only option A doesn't require the IRS approval, because correcting a math error does not require the consent of the IRS. Math error can be corrected without seeking formal permission. So option A is the correct answer. Let's go to the next question. In order to adopt a fiscal tax year on its first federal income tax return, the taxpayer must A. Maintain books and records and report income and expenses using that tax year. Option B. Attach a completed Form 1128 to his fiscal year basis income tax return. Option C. File a short period return. Option D. Get IRS approval. Let's see the answer. The answer is A. So here, to adopt a fiscal year, a taxpayer must maintain books and records and report income and expenses using the same tax year. So option A is the correct answer. Let's go to the next question. The taxpayer is a merchant who has purchased inventory item. He withdrew some of these items for personal use. He must A. Increase his sales by the cost of items withdrawn. Option B. Reduce the cost of purchases by the cost of the personal use item. Option C. Reduce the cost of purchase by the FMV of the personal use item. Option D. Reduce beginning inventory by the cost of the personal use items. Let's see the answer. The answer is B. Let's see why it is B. So here, if a taxpayer purchases inventory items, the cost of inventory used for personal use must be deducted from the total purchase. So the answer is B. So here, with this, we have finished section 1, chapter 1 MCQs.